Our next topic is financial reporting standards and basic financial statements. Here we'll have 4 lessons, starting with accounting standards. Next, the users of financial statements. Third, the accounting equation and identifying the basic financial statements. And then looking at an example company, in this case Intel. Financial standards in the United States are set by the Financial Accounting Standards Board, which is a self-regulating body of certified public accountants. FASB will come up with principles that they publish for adherence by the community, the corporations in the United States. And we call those GAAP, Generally Accepted Accounting Principles. Reporting standards are also set by the SEC, and these are for the reporting of public companies to the SEC for their annual filings. So FASB governs all reporting by all companies that are audited and want to be in compliance with standards. If you're a private company, you're covered by those GAAP standards. If you're a public company, you're covered by both GAAP requirements and the SEC. The SEC and the FASB worked very well together, so they generally have identical views on reporting. Otherwise, it would be quite chaotic for public companies. The PCAOB looks at internal control processes and guards against companies that have faulty reporting and faulty systems for assurance of integrity in financial reporting. The audit community creates their own set of standards, generally accepted auditing standards, which are the rules and processes that are used by auditors as they examine the statements. So these are not GAAP. These are not principles of accounting. They're how do we audit to assure that the audits have the end result that we want, to assure the users of statements that they're not misrepresented in a material way. So we see a lot of collaboration among all the parties involved in setting these standards. So in US GAAP, there are certain principles that are very important, and we'll just cover a few of them just to understand what we're talking about when we discuss GAAP. First is accrual. So accrual is this word people don't even understand. So I'll describe by showing a difference. The simple way that most people think about accounting is cash basis. When a customer pays me, I earn revenue. When I pay a bill, I have an expense. Now, although that makes sense, that's not how the economic transactions occur. Because what if you did work for, say, Google, and you did work and they owe you $1 million, but they haven't paid you? From an economic standpoint, have you actually done the work? Yes, you've done it. Have you billed Google? Yes, you have. Do they have any problem? No, they think it's fine. Have you gotten paid? No. So from a cash basis, you have not received cash. You cannot count that you've done worthy work for $1 million. But from the economic reality, you've earned the money because you've done everything you needed to earn the money. We call it performance obligation has been met. Under accrual basis, it breaks apart the connection with cash such that you can record revenue when you've earned the money, when your process of completion is done, and that you've done everything to meet the requirements for the contract. Then you can count revenue. So if you get paid later, that's okay. You won't count revenue twice. You count it once when it's earned. When they pay you, fine, we want the money, of course. So that's one difference. The other is on the other side. Let's say you contracted for someone to paint your building, and they've done the work, and it's a $10,000 job. Well, if you haven't paid them, do you owe the money? Yeah, you owe the money. Did they do the work? Yeah. Did they do good work? Yeah. Do you know you owe them? Yeah. Well, it really, from an economic standpoint, is an expense for painting the building. But from a cash standpoint, you haven't paid it. So again, accrual basis says recognize the expense when it's incurred. So when somebody does the work that they promised to do and you owe them the money, you should recognize the obligation that you owe the money and recognize the expense as being an expense of your business. So that is the level of detail I want to get into at this point about accrual basis accounting. It is simply revenues recorded when it's earned, expenses are recorded when it's incurred. Notice the word cash never entered into it. The second is revenue recognition, which is when do you count revenue as earned? And the GAAP standard is when the contract obligations have been met. If I promise to do a delivery of some goods to a customer, and I've delivered the goods to the customer. I've met my obligation, and they owe me the money. That means I earn the money. So that's a very simple one. When you go to a barista, let's say Starbucks, and you order the cappuccino and they hand you the cappuccino, revenue is recognized, right? Now, sometimes it's a little fuzzier where, say, software, you deliver software to your client, but the client hasn't yet proven to itself that it works perfectly and is not yet acceptable. Can you count the revenue? So there are definitely gray areas on when do I count revenue. But the simple case is what I just said. When the process is complete and you've met your contractual obligations, then you can count it. Matching is, let's say you counted the revenue. You need to match the revenue you just recognized with the cost it took to get that revenue. If I sell a car, I need to not only record the revenue that I sold a car, but I need to recognize the expense as a cost of goods sold because I gave up a car. So matching is just like the word sounds. If you count revenue, you better count the matching expenses. Historical cost is one that is unpleasant sometimes because it leads to distortion. It means that we count the asset value of something we buy based on what it cost us. And if we bought something for $1,000 yesterday, it's on our books today and tomorrow at $1,000. Where it gets a little distorting is, let's say you bought a piece of land 50 years ago in downtown New York. And that land is probably worth a lot more money now than 50 years ago. But if you haven't sold the land, it will stay on your books and records as the cost of the land 50 years ago. So historical cost is objective. You have the receipts to prove it, but it's not exactly timely, is it, in terms of market value. This is one main observation about accounting, is that often assets on the balance sheets of companies are understated because they record it at the historical cost, not the current market value. Time principle means that we measure time. We record and report on an annual basis in a year. And we have quarters. And so we report our information to investors and the SEC on a quarterly basis for interims and on an annual basis with full sets of financial information. Monetary principle is we deal with money. We deal with dollars if we're a U.S. corporation. We don't deal with things that are hypothetical or things that are other currencies. If they're in other currencies, we need to translate from that currency and convert it to U.S. dollars. So monetary principle means we record transactions in monetary terms and that we have one reporting currency for each company. And materiality is the precision that we give is what is necessary so no one will make a mistake in using the information. For example, if Intel, we're going to talk about Intel later, if Intel has a petty cash box for incidental purchases made and they're off by $10, will it change any of our opinion of the cash balance of Intel if they're off by $10? No. So materiality means that if the error is big enough to make a difference, it must be discovered and disclosed and fixed. However, if it's not material, then that level of precision is not promised by the company or their auditors.